The day confidence vanished. At first, nothing looked broken. Prices slipped, then belief cracked. And when confidence disappeared, markets did what they always do. They ran. It never begins with panic. The screens still glow, the anchors still sound calm. Losses are called healthy corrections. Analysts explain it away. Traders nod. For a moment, the system pretends it's in control. Then comes the silence. Phones stop ringing. Buyers vanish. Spreads widen. Prices fall faster than explanations can keep up. Not because the world changed overnight, but because perception did. Market crashes don't start with numbers. They start with doubt. For months or years before the fall, confidence had been quietly building. Rising prices rewarded risk-taking. Caution felt unnecessary. The crowd learned a simple lesson. Being optimistic paid. By the time the first cracks appeared, belief was already invested. That's why the initial warning signs never feel dangerous. They feel temporary, manageable, rational. But markets are not machines. They are emotional systems disguised as math. And when confidence finally breaks, it doesn't unwind politely. It collapses. Selling feeds on selling. Fear spreads faster than information, and what looked stable hours earlier suddenly feels fragile. This moment, the instant belief turns, is the same moment repeated across every crash in history. Different assets, different eras, same human reaction. Because when confidence vanishes, logic follows it out the door. The illusion of control. Why booms feel permanent confidence doesn't arrive loudly. It settles in quietly. At first, investors are cautious. They remember past losses. They hedge. They hesitate. Then prices keep rising. Volatility fades. Losses become rare. Every dip is rewarded. The brain begins to adjust. Success stops feeling temporary. It starts to feel earned. Skill replaces luck in the story people tell themselves. Risk doesn't disappear, it's redefined. Models grow more detailed. Forecasts sound more certain. Uncertainty is buried under data and confidence. People don't believe markets are safe. They believe they are prepared, that they'll recognize danger early, that exits will stay open. History feels distant. Past crashes are explained as failures of weaker systems, not warnings. Rising prices validate belief, and belief hardens into certainty. That's when risk stops feeling like risk at all. Crowd behavior when thinking is outsourced. Markets don't move because of facts. They move because of people watching other people. No one wants to be the first to doubt. Doubt is uncomfortable. It isolates. As prices rise, agreement forms. Not through debate, but through repetition. Everyone sees the same charts, hears the same explanations, shares the same confidence. Soon, independent thinking feels unnecessary. When others are making money, skepticism feels expensive. Sitting out feels like failure. Questioning the trend feels like ignorance, so decisions shift. People stop asking, "Is this sustainable?" They start asking, "What if I'm wrong to stay out?" This is how crowds form. Not through greed alone, but through social pressure, through the quiet fear of missing what everyone else seems to understand. Warnings still exist, but they sound distant, abstract, unpopular. The crowd doesn't silence dissent intentionally. It simply stops listening. And once thinking is outsourced to the group, markets stop reflecting reality and start reflecting belief. That's when prices drift farthest from fundamentals, right before the turning point. Hidden fragility, leverage, debt, and false safety confidence doesn't just change behavior, it changes structure. As belief grows, safeguards loosen. Borrowing feels reasonable. Leverage feels efficient. Debt feels manageable. Risk isn't removed, it's layered. Loans stack on loans. Promises rely on other promises. Complex instruments spread, exposure so widely that no one feels responsible for it. Everything works as long as markets stay calm. This is the quiet danger of optimism. Stability encourages fragility. When prices rise steadily, leverage looks harmless. Losses appear theoretical. Stress tests assume cooperation, not panic. Safety becomes a story told by models, not a condition tested by reality. The system grows dependent on confidence, on liquidity always being there, on buyers always stepping in. And because nothing has gone wrong yet, the structure is trusted. This is where psychology and mechanics merge. Belief allows weakness to hide. Debt hides behind rising prices. Leverage hides behind confidence. By the time stress appears, the system is already tight, interconnected, and unforgiving. It doesn't need a large shock, just doubt. Denial phase, early warnings. Nobody wants to hear the warning signs never arrive as sirens. They arrive as inconveniences, a small spike in volatility, a market that stops, responding to good news, liquidity thinning at the edges, nothing dramatic, nothing headline-worthy. And that's why they're dismissed. In a confident market, every signal has an explanation. Losses are temporary, strains are isolated, risks are already priced in. Stories rush in to protect belief. Central banks will step in. Earnings will catch up. Innovation will solve the problem. These narratives aren't lies, they're comfort. The human brain resists information that threatens certainty, especially when careers, reputations, and wealth depend on that certainty. Doubt feels irresponsible. Optimism feels professional. So early warnings are reframed, minimized, or ignored. Not because people are blind, but because seeing clearly is emotionally costly. This is the most dangerous phase of a bubble. Not ignorance, but selective attention. Because by the time denial ends, options are already gone. And what follows is never a debate. It's a reaction. The snap, from rationalization to panic. The breaking point is rarely obvious at first. It's not a crash, it's a pause, a failed auction, a missed payment, a headline that doesn't fit the story. For a moment, markets hesitate, then someone sells. Not to panic, to be prudent, but in a system built on confidence, selling is contagious. Prices slip, stops trigger, liquidity vanishes. What was manageable yesterday becomes urgent today. Explanations fall behind the tape. Models stop working. Correlations snap into place. Fear doesn't spread because people are irrational. It spreads because survival replaces optimization. Every participant suddenly wants the same thing, out. But exits are narrow, and everyone reaches for them at once. This is when markets reveal their true nature. Not efficient, not orderly, but reflexive. Selling creates lower prices. Lower prices justify more selling. The feedback loop tightens. By the time panic is visible, the damage is already done. The crowd that once provided comfort now amplifies fear, and the realization sets in quietly, then all at once. There is no flaw, only confidence, and it's gone. Aftermath, how crashes rewrite memory. When the selling stops, confusion sets in. Screens stabilize, headlines slow, silence replaces noise. Then comes the search for meaning. Suddenly, the warning signs seem obvious. The risks feel undeniable. Everyone remembers noticing them. But memory is flexible. What was once dismissed is now emphasized. What was ignored becomes central. Narratives are rewritten to restore a sense of control. The crash is framed as inevitable, as if the outcome was always clear. This isn't dishonesty, it's psychological repair. Admitting surprise is uncomfortable, admitting participation is worse, so blame shifts outward, to institutions, to regulators, to abstract forces. Meanwhile, confidence lies damaged. Investors hesitate, risk feels heavier, time horizons shrink. If you want to know more about behavioral, finance and panic psychology, stay tuned and don't forget to subscribe.